Hello and welcome to S&P Global Ratings Fixed Income in 15, a 15-minute chat with a market voice and an S&P executive. My name is Joe Cass. I head up market outreach here in the UK. Today I'm joined by Dr. David Kelly, Chief Global Strategist at JP Morgan Asset Management, and the Global Head of Rating Practices here at S&P Global Ratings, Craig Parmelee. Thanks very much for joining me today, David and Craig.
Glad to be here.
Thank you.
So before we start, just a quick reminder that the views of the external guests on the show today are their views alone, and they do not represent the views of S&P Global Ratings. Okay, David, let's kick off with some questions for you. What major trends are you seeing in the global fixed income market today?
Well, I think we're seeing two conflicting trends. One of them is obviously central banks continuing to be very easy. We've obviously been through a traumatic experience in a global pandemic and a global pandemic recession. Central banks, since the great financial crisis, have been falling over themselves to say we will be easier, we've got more things in our toolbox. So we're seeing a lot of bond purchases, a lot of commitment to low rates for a long time. And that's one force. The second force, though, is, and this is going to become much more apparent over the next few months, is we are going to see an end to the pandemic. 2020 was the year of the virus. 2021 will be the year of the vaccines. And what I think we will see is a synchronized pickup in world economic growth towards the end of the year, even as we've got a lot of fiscal stimulus pouring into the economy around the world. So I think that does set up a tension between central banks who are very easy and an economy which is really heating up a lot faster than many people thought it would.
Sure. David, it's been an extraordinary year in credit. So what's your high-level outlook for the markets, specifically on the credit side of things?
Well, unfortunately, of course, the problem with when you have a relatively good year in terms of credit spreads and in terms of people's willingness to buy these bonds, you end up at very low yields, very low spreads, and really across the board, we're seeing those very, very tight spreads, which really can't be justified based on the fundamentals. I think it's much more of a sort of momentum trade where people have piled into these assets for many years. It's worked during the pandemic, and so people are continuing to do this. But that does limit returns going forward. So we think that it's going to be difficult. And I think one of the things that happens is when rates all come down towards that zero lower bound, when spreads compress, when yield curves flatten, what ends up happening is you're just paying too much. You're paying too much to take duration risk. You're paying too much to take credit risk. There's a little bit of trying to pick up pennies in front of steamrollers here about this, but I think that overall most parts of global fixed income are pretty expensive today, after a lot of liquidity added by central banks and really a lot of very willing buyers of bonds of all sorts.
Craig, how do you view the current macro environment from a ratings perspective, possibly touching upon the outlook for global banks?
Well, thanks very much, Joe. Of course, the macro environment is impacted by the fact that many countries continue to struggle to contain COVID-19. It's impacting many sectors and credit markets as a whole. But as David said, there's room for hope. The vaccine is being rolled out, or vaccines, around many countries, and there are different proposed stimulus measures still underway in the U.S. and perhaps other countries. In terms of global banks, first let me highlight a terrific article that our team published in late November, a forward-looking 2021 outlook article. It begins by talking about activity in 2020. There certainly were a handful of downgrades among global banks in 2020, but on the whole, a fairly limited number when you compare it to other sectors like corporates. But we do have about 1/3 of our outlooks on global banks as negative today. And so what that means is, looking forward, perhaps there's a probability of a 1 in 3 chance of a downgrade for some of those names over the next 1 to 2 years. Now, we do expect that recovery of global banking systems to pre-COVID-19 levels will happen over time, but it's going to be slow and it's going to be different depending on the country. In many systems, we expect recovery to pre-COVID-19 measures by the end of 22 2022. But in some cases, including many developed nations like the US, the UK, France, and Germany, we believe that recovery to pre-COVID-19 measures is going to extend into 2023. Uh, there are many key risks out there for global banks. Obviously, an already high number of corporate defaults globally, the fact that many corporate customers remain highly leveraged, persistently low interest rates, and the fact that that puts pressure on net interest margins and therefore profitability of banks, the potential unwinding of liquidity support that's been uh, provided by governments across the world. Of course, shifts in technology that affect consumer preferences that perhaps lead to competitive disruption, and even the fact that from a regulatory perspective and from an investor perspective, there are changing priorities in terms of ESG related factors that banks are having to adjust to. And so conditions and takeaways certainly differ by country. So I very much recommend the article that we published in late November.
And Craig, your role spans all global sectors. So from your kind of bird's eye view, what are you seeing from an ESG perspective across sectors if you had to compare one to another?
Yeah, thanks, Joe. Well, look, we think a lot about sustainability. We get lots of questions from the marketplace, from investors, policymakers, and regulators. And we have actually built quite a sizable sustainable finance team in our ratings division. It now has 30 people and it continues to grow. That group helps us to think about how ESG factors into our credit ratings, but also how we might develop standalone benchmarks to help the market think about ESG factors. When it comes to the companies we rate and we engage with, we have observed an evolution over the past few years. Many management teams have become much more sophisticated in their sustainability reporting and their climate scenario planning. We see that in that there's lots more detail in climate change scenarios that show up in these sustainability reports. Also, companies are adopting non-financial reporting guidelines. That means there's better comparability, a better understanding of what metrics are most relevant depending on the sector. And so the data is just getting much better out there. And we've even observed an increasing number of management teams, and depending on the sector, who have actually tied compensation to ESG targets. So some really good progress over the past few years in sustainability.
And David, I'd be interested to get your thoughts on ESG too. So how do you view the role of ESG and sustainability in the current investment universe?
Well, I think the key thing to think about ESG is more as an opportunity rather than a constraint. We are obviously going to see a cyclical bounce back from a pandemic economy worldwide, but once that cyclical bounce back is over, the global economy, particularly the developed nations, Europe, United States, Japan, are going to return to their slow-growing ways of the late 20 teens. And in that slow growth environment, people are going to be looking for, well, where can we find faster growth? And we do see, particularly in the area of energy, I think there will be a global commitment to trying to tackle climate change, reduce carbon emissions. I think that will put a lid on fossil fuel prices, but also there will be equally a lot of investment around the world in technologies which reduce our carbon footprint one way or the other, either more environmentally conscious energy production or ways of reducing energy consumption. And I think that's going to spawn a whole pile of, and is spawning a whole pile of investment opportunities. Some of them will not work, but some of them will. And if you're looking for winners in the future, you've got to find a growth vehicle. I think ESG, apart from all its other virtues, is a growth vehicle. So I think people have to pay attention to that. I think it's also important, you invest for the landscape you're in. And so while I think there are opportunities, you also have to recognize that as governments, as people get more and more concerned about this issue, they will try to regulate the environment, the financial environment, the economic environment, to try to achieve ESG goals. And so it's very important that companies adapt and are able to flourish in that kind of environment rather than actually suffer from that increased regulation. So I think I think we have to be aware of the constraints that ESG will put on us, but also very much see the opportunity in some of the growth areas of trying to deal with some of these issues.
Thanks, David. So now it's time for some non-market related questions. So Craig, starting with you, you've been at S&P for over 20 years, before which you were at State Street in a commercial banking role. So you've met a wide range of senior government officials, CEOs, and investors in your time. So which individuals stand out as particularly impressive or even memorable?
Well, thank you very much, Joe. This is a question that can get me in trouble. So let me answer like this. Yes, I've had a terrific opportunity to meet senior leaders from around the world in my positions, and I'm very fortunate in that regard. Immediately after the global financial crisis, I was directly involved in leading our teams that cover banks, first in the U.S. and Canada, and then I moved over to Europe, and so I had oversight for Western Europe. So that was a pretty intense period, as you can imagine. And because it was an intense period, a number of the CEOs from these major banks actually attended our analytical meetings in person. And so during that time frame, I got to meet folks like James Gorman from Morgan Stanley and Lloyd Blankfein from Goldman Sachs, and uh, uh, Vikram Pandit from Citibank, a phone call with Jamie Dimon along the way. Over in Europe, Emilio Boten from Santander, Anshu Jain from Deutsche Bank. Over in Australia, Nicholas Moore from Macquarie. So quite a great opportunity to meet some of the leaders of global banks around the world. There was also a point in my career where I was very much involved in covering the gaming industry. And this goes back a couple of decades, but at that time I got to meet with Sheldon Adelson, who recently passed, and Steve Wynn, and of course another individual who later became president of the United States. So as you can tell from my answer, it's really difficult to single out a particular leader, but collectively, it's been really an honor to have an opportunity to sit across from many of those individuals and talk about their philosophies of business and their plans to lead their company in many different economic scenarios.
Fantastic. Thanks, Craig. David, I understand that you are a keen runner. So how have you adapted your training regime to kind of the restrictions of the pandemic?
Well, I'm a keen runner, although not necessarily a good runner, but I've always run. I remember I started running. I was playing rugby and in Ireland, and we got ourselves a New Zealand rugby coach who took one look at the lot of us and just told us to take off our cleats, put on some running shoes, and get fit. And I sort of gave up the rugby and took up the running. It's actually been really good in a COVID environment. I don't live in the city. I live in a town called Acton, Massachusetts, up northwest of Boston. And so there's plenty of country and deer and chipmunks and squirrels and so forth. And you have to occasionally wear face coverings as you run when you're running past people. You can take them off or take them down when you're not going past people. But it's one of the things you can do, and it helps. It's an area of normality for me in this weird environment. One thing I did do, which was kind of fun, is I ran the virtual Boston Marathon. This is my fourth marathon. I ran the actual Boston Marathon very badly in 2019. I had an injury which I was dealing with, but I ran a virtual marathon, and all the neighborhoods, all the neighbors came out to wave me on at a socially distanced level, and it really was sort of a pleasure training for it and doing it. And you realize that you can adapt to deal with these conditions. And that's one of the lessons of 2020. It's been an awful year, obviously, for everybody, but really what I've been so impressed by, not in running so much, but in everywhere, is how people have managed to adapt what they do so that they can survive and thrive even in this very weird world, and even as we all hope and expect a return to normality over the course of 2021.
Craig, you've also been getting some miles in, but indoors. Tell us a bit more about that.
Yeah, well, first let me say that David, the virtual marathon sounds like a lot of fun. I used to be a runner, but I've found that it impacts your knees over time. So, about 3 years ago, I purchased a Peloton bike, and anybody who owns home exercise equipment recognizes that sometimes you're very committed to it, and sometimes you're not. But as David was just saying, as we were moving from October into November, and I was thinking about being indoors in this pandemic, I realized I needed a positive pursuit to get me through it, and so I recommitted to my Peloton bike, and have been hitting the miles, as you say. I've done about 40 rides since the beginning of November, about 445 miles. So really every other day I get on that bike and go.
Excellent. You guys are putting me to shame right here. David, one last question, and last question goes to you. So on Fixed Income in 15, I usually interview leaders, influential individuals from kind of the world of finance, much like yourself and Craig. So from your experience, who would make a great next guest for me on the show?
Well, of course, I'm a little biased because I know some great fixed income managers within JP Morgan, and to be honest, I think the best guest I know would be a guy called Bill Egan, who runs a rather unconventional fixed income fund, but he's full of fascinating opinions. I think you'd. I don't know if you could quite compress him to 15 minutes, but you would certainly find him an energetic and very interesting guest.
Great. Well, my thanks to David, my thanks to Craig for your time today. Thanks everyone for watching, and see you next time on Fixed Income in 15.